everybody. I am always super excited to have this guest and his gigantic brain come on the channel. I'd like to introduce Dave Kranzler. We've done a few of these now. Again, I'm always excited to have you on. Today, we're going to talk about housing, precious metals, in the stock market. Dave, welcome to the channel. How you doing?
Doing well, Greg. Thanks for having me on again. It's great to chat with you.
Oh, you're very welcome. The pleasure is all mine. So today I do have a couple questions from some of our Patreon members, and I would love to dive into housing. And you give me any of your takes on it, whether you want to go national or not. And I know some of the guys in our Patreon group here are in Colorado. I'd love your take here, given both you and I also live here in Colorado. So go ahead. Where are we at with housing? What the hell is going on?
Well, that's a loaded question. I mean, there's a lot to unpack there.
Can I start with this? I sent this to Dave the other day, and this is a real listing. My realtor sent me this. You have to. I could post this for people too, but the description here says this house is a total disaster, sold as is. Listed for $429. My realtor told me that it's already pending and went over ask. And your take on this was that looks like it's basically just a garage. This is Colorado. Yeah, go ahead. Where are we at with housing? Is it this?
I mean, that kind of sums it up. I mean, this is like the early 2000s housing bubble on steroids. I mean, this thing makes the .com bubble look rational.
What do you say to people that say, well, this time, well, anytime you hear someone say this time it's different, you usually want to run the other way. But a lot of people are saying, look, at this time it is different. If you watch like the movie The Big Short, you've got strippers in there buying 4, 5, 6 homes. People are saying today that's different because the mortgage market has become a lot more, air quotes, secure. I mean, what's your pushback on that?
Well, I mean, the trying to make comparisons is highly disingenuous, because if you look at what caused because the last time around it was basically a mortgage bubble, and that's what we're in now. But it was something like, I think that the default rate overall was maybe, like, people want to blame it on the subprime mortgages, the 125 LTVs, no income verification. But I mean, the overall default rate was a lot lower than I think you would have expected. I know when I saw the number, and again, this is off the top of my head because I haven't looked at the numbers in a long time, but if I think I recall,
I thought that's all you did with your life. I just thought you just sat around and looked at numbers. No.
I feel like I do. But I think I recall, the overall national default rate was something like 5%, something like
really?
that.
Okay. I didn't know that. I would have assumed
And I think
higher.
that might include prime grade mortgages. I don't remember, but it was a much smaller percentage than you would have expected, because all you heard about was, the house flippers using these crazy mortgages and leveraging up, buying multiple houses. There was one story that I remember. There was some guy who had managed to piece together an 8-home portfolio from jail. But
wow,
and that was extreme, but a lot of the same stuff is going on. It's going on, by private pools of capital. There's private pools of capital that have been extending, the types of mortgages that we attribute to the bust of the first housing bubble. You just don't hear about it. And you might not have.
Expand on that, Dave? Who are these people? What do you mean by that?
I mean, someone who was a mortgage broker showed me a term sheet from a company that I think was actually owned by Citadel, the hedge fund. Mm-hmm. And they're offering high interest rate, no down payment, type mortgages, but it's private, it's private label mortgages. So you don't, it doesn't necessarily get reported. So, anything that's underwritten by Fannie Mae or Freddie Mac, you can actually see it, if you go dig for the data.
Right.
And there's been so much money printed, and investment funds have accumulated so much capital that they have to do something with the money. So one of the things some of these investment funds have been doing has been, they're lending they've started giving out these subprime mortgages, no income verification, et cetera.
Yeah, that's crazy. And that you and I had kind of talked about this. I pulled this from CNBC to kind of, I think, pile on to your point there. You can see up here, it says the adjustable rate mortgages share of applications last week was over 9% by loan count, 17% based on dollar volume. At 9%, the ARM share was double what it was 3 months ago.
Now, one thing that I meant to look up before we or see if I could find the answer is that for refis, or is it for purchase mortgages, or both?
You know what? I'd have to double check. I know it was mentioning refis here too. You can see that down here below. It says fallen about 71% from the same week a year ago. Yeah.
I would say it's probably both refis and purchase mortgages, but again, when you get to that point where you're borrowing, you're borrowing using a mortgage that has a fixed rate for 5 years and then adjusts based on the interest rate at the time 5 years from now, that means you're stretching to have to buy a house.
Yeah, and I would assume anyone that's got a couple brain cells to rub together, I wouldn't you assume interest rates are going to go up from here, or am I wrong there? You think the Fed's going to come back in and just?
Well, that's a whole other discussion to have, because I don't know how far the Fed's going to be able to take this interest rate hike program without completely blowing up the economic and the financial system, the economic system and the financial system. So it's hard to say, but I do think, I think at some point that the market itself is going to force interest rates higher at the longer end. So the Fed obviously can control the interbank overnight lending rate, which is essentially the Fed funds rate, or that's the rate that banks can borrow from the Fed, but they don't have as much control over the long end unless they print tons of money and buy longer maturity bonds, which they have been doing, by the way, which is why we have which is why the interest rates at the long end don't even remotely reflect the true rate of inflation. And not even just the true rate of inflation, the interest rates at the long end of the Treasury curve don't even remotely reflect the phony CPI inflation.
That's what gets me, and if you're following someone like yourself, as I do, you start to realize, I don't want to call them a lie, but I think it's more of a mistruth. And, for them to talk about tackling inflation just to get to their phony CPI, we got to raise interest rates to what, 8.5. I think that kills everything.
That's right. Oh, absolutely. Yeah, exactly.
And inflation would still rise, I think, in that environment, potentially, right? If real inflation is much higher.
You got two factors here that cause the inflation. One is the artificially low interest rates, but the primary factor is all the money that's been printed. They call it QE. So what? The Fed's creating. Technically, the Fed's creating bank reserves, right?
Yeah.
And then the banks turn around and transmit that into the financial system and into the real economy with loans or whatever. Mm-hmm. So it's just simplistically it's money printing and the money supply increases, but you can't just look at the money supply. You also have to look at credit creation, because when a bank lends money, they're taking, for, let's say the Fed hands the bank $1 of printed money. Well, because of the reserve ratio, which was removed in April 2020.
Oh my gosh.
they can lend that dollar out 10 times, or that dollar gets lent out 10 different times or 9 different times, when the reserve ratio is at 10%. So essentially you're turbocharging the actual money supply with the fractional banking system.
Yeah.
And that's
scary.
I mean, yeah.
To me,
when you think about it, money that's borrowed spends the same as money that is printed until the money that's borrowed is repaid. Well, what happens is, especially with the government, that money often never gets repaid. The primary culprit in this inflation is not, believe it or not, it's not Vladimir Putin. It's the massive devaluation of the dollar from all the money that's been printed. And that's where, that's your primary source of inflation. Now, what they can try to do is there's also a supply and demand component there. They can try to kill demand, the demand side of that equation, by raising interest rates and crashing the economy. And that's essentially what Volcker did.
Right.
So, but if they, back then, the financial situation in the private sector and in the public sector, the fiscal condition of the government and the financial condition of households and businesses was much stronger than it is now, because back then there wasn't a lot of, the amount of debt that was outstanding in the entire system was like a fraction of what it is now. Yeah. And back then, believe it or not, the US was still, I believe by 1980, I think it still had a positive balance of trade.
I was just born in 1980, so I don't know.
Yeah, I'm pretty sure it did. But either way, the entire foundation of the economic and financial system was like blue chip compared to what it is now. Now it's a near default junk bond. So, the Fed's trying to raise interest rates. That doesn't necessarily, that doesn't address the money devalue, the currency devaluation that's occurred from the money printing, but it might cause demand destruction, and they hope to cool prices that way. But really what the Fed needs to do is they need to start removing a lot of that liquidity that they printed and threw at the banks, really going all the way back to 2008. But I mean, the Fed's balance sheet has more than doubled since 2020. Yeah. And they started the process of trying to shrink the balance sheet, prior to 2020.
2018. That's right, when I sold my house, because I thought
but weird. They didn't get very far. I think they were able to reduce the balance sheet by about 10%. But that's why you had that big market crash in December 2018.
It was the largest ever in a December, if I remember correctly.
Yeah, that could be. I'm pretty sure I'm accurate,
but yeah.
Yeah. So, but that shows you what happens when they try to remove the liquidity that they're printing from the system. And at that time, I think they raised the Fed funds rate maybe from 0 to, I don't know, maybe 2% or 2.5%. I forget.
Yeah.
And then they had to start, then they had to start taking rates back down again. Well, now it's like there's all this hoopla about how tight the Fed's monetary policy is, which is total BS, because first of all, 2 weeks ago, the Fed balance sheet hit a new record all-time high. And
I didn't see that. That's hilarious.
Where's the Fed funds rate? The Fed funds rate target is 0.25 to 0.5%. Explain to me how that's tight monetary policy.
Yeah, it's
balance
not.
sheet's hitting a new record. It actually went down a little bit last week, but for the most part, the balance sheets hit a new all-time high. It's at an all-time high, and the Fed's nudged Fed funds rate up 0.25%.
Yeah.
So I mean, they're not really making a serious effort to subdue inflation, if that's all that's been done so far. I mean, they've been talking about this since like last August or September.
I think so. Yeah, that's when it started.
Yeah.
Which is why the market, I think, started to roll over, because they were just talking about doing it. And
Yeah,
I mean stock market, not housing market.
right. No, I knew you were referring to the
Yeah.
stock market.
Yeah.
So,
Yeah, go ahead, finish your thought there, and then I wanted to transition into a couple questions if you're cool with that from guys.
oh no, we can do questions. I was just going to say, I mean, in my opinion, I think in most areas of the country, obviously there's still some red hot areas, but in most areas of the country, I think housing's peaked and is starting to head south again.
Okay, yeah, okay, that's kind of where I want to get to. So I want to just tell my story real quick, and I'm gonna read both the questions too because they kind of flow together, and then I'd love your
Sure.
response to them. So I sold my house 2018. It's literally just gone straight up. I'm in the market looking. I know that it's absolutely ridiculous. So Phil here, he's asking a question, and this was one of the things that I knew something was wrong in 2018 when I just kept watching homes tick up. I was like, this can't be the average American buying homes. So Phil's question here, he goes, hey, I live in Denver. Is there any data or information on cash versus mortgages? Is there anywhere to go and access that? And what are you seeing? And the reason I really like that question was because I was actually talking to my realtor in like 2019 going like, do you have, is this funds coming in? Because this doesn't make any sense to me. Because I know like most of my friends, they have no savings. Like they have jobs, they're proactive people, but a lot of them, I think they live, not necessarily paycheck to paycheck, but I don't think a lot of them could go for a month without, having to access credit. And then the other question was, this is from David. What are your thoughts on rates increasing? Is that going to apply pressure on homes and the stock market? So basically, do you have information on data as far as cash versus people taking out mortgages? And, what are your thoughts on rates going up? Is that going to harm housing or what?
What do you mean cash taken out on mortgages? You mean like how much
No, sorry,
cash are they?
he's sorry. He was asking cash purchases. Excuse me. Sorry if I misread that. Cash purchases versus people taking out mortgages. Do you have any information and data on that? Like, is it still? I've seen like in give me an example. Like in Jacksonville, Florida, I've seen something like 33% of homes purchased are with cash. They're just investors coming in.
Right. Well, then you need to know what percentage of those cash investors are corporate buyers, because that's been a big influence on the entire market, on the supply of homes, and on the upward price pressure is big companies like BlackRock. They have a whole separate subsidiary that just goes around and buys up whole neighborhoods to rent them out.
Yeah, I think I think they have 80,000 homes, single family homes they've purchased now.
I don't even know the number anymore, but
I think it's
actually,
80,000.
some of those companies that buy homes and rent them out, I think they make good shorts.
Oh, interesting. You just think they're well, why? What's just carrying too much debt? Or not debt, but too much on their balance sheet?
Well, what so when you're buying a home to rent it out, you're making assumptions, especially if you're using a mortgage, you're using assumptions about what kind of rental income you can bring in. And you just assume that it'll be steady state, or you'll be able to increase that over time. What's going to happen is, excuse me, is that as the economy continues to crater, you're gonna, and as people's real incomes continues to decline. I mean, yeah, there's been wage increases on a macro basis for the workforce, but ex inflation, their real wages are declining. So that's going to limit how much you can pay for your housing, right?
Oh, I mean, absolutely. I mean, just from what I eat, I try to eat fairly healthy, organic foods. A lot of my stuff that I purchase is up 40-50%.
Oh yeah, easily.
Yeah.
So, I don't know so much for the corporate homeowners, corporate, own and rent homeowners, but for, just the mom and pop operations, a lot of them use mortgages to buy the home that they're going to rent out. And their mortgage payments are predicated on, a certain level of receiving a certain level of rental income. Well, if you've got a large portion of the population that all of a sudden their real income is shrinking, they'll be forced to have to allocate less money to what they pay for a roof over their head, right? So,
Yeah, absolutely.
you buy a house, you rent it out, and you're getting a nice fat rental payment for a couple of years. And then all of a sudden in 2023, your tenant leaves, either they can't afford it, or maybe they finally are able to buy it. Whatever the reason is, your tenant vacates and you go to look to put in a new tenant, and you think, oh, well, I'll raise the rent. So it sits empty for a while, no takers. And then all of a sudden, you have to lower it. Oh, well, I'll just lower it back to what I was getting before, no takers. And then all of a sudden you have to reduce it quite a bit in order to get someone into the house so that you can cover, the overhead of maintaining the house and the debt service. And then all of a sudden, your buy to rent model isn't working so well, right?
Yeah, totally.
And I think that's the dynamic that we will see that gets set in motion. It may already have started.
Is there anywhere, or maybe there's multiple places that you can go to see that data? So that was my big struggle. Had I been able to find that, maybe I should have called you, but I think I may have purchased a house a little earlier than I did. But
well, just in terms of nationally, I'm sure like for Colorado, you can find this. I'm sure the Colorado Association of Realtors, which would be part of the National Association of Realtors.
Okay.
I'm sure the Colorado Association of Realtors has this data for Colorado, but just on a national basis, and this is the existing home sales report for March. They break it out in here in the news release narrative. So individual investors or second home buyers who make up many cash sales purchased 18% of the homes in March. So 18% of the existing home sales in March were from second home or investor buyers.
Any idea if is that above average, or is that any?
Well,
I have no idea.
It was down from 19% in February, but up from 15% in March.
Okay.
So, and then all cash sales accounted for 28% of transactions in March, up from 25% in February and up from 23% in 2021. So, but like the narrative says, most of those cash sales were from investors. Well, they say individual investors, but I don't think whether they don't tell you whether those were corporate buyers or individual investors. Very well could be individual investors. I don't, who knows?
Yeah.
So that's just the national data.
Okay. No, that's good. That's good feedback. And then David's question was, what do you think is going to happen with rates? And then I would like to play devil's advocate a little bit after you answer that, and then we'll transition into metals.
I don't know how much further the Fed's going to raise the Fed funds rate. I mean, I think an interest rate hike at the next meeting. I think it's next week, actually.
Yeah, it is. I believe.
I think that's baked in the cake. So then it's just a question of whether it's a quarter of a percentage point or a half a percentage point. I think there's been enough telegraphing that it looks like it'll probably be half a percentage point.
Do you think that that will not impact stocks then, if everyone's just already, if it's baked in?
That's, it's hard to say. That's a whole other conversation, because you're going to start to see bad earnings reports affect the stock market. But
yeah, we're starting to see that a little bit right now.
Yeah, we already have been. I mean, Amazon, when its numbers hit the tape, I mean, it's down over 10% right now.
Yeah, that's fine. I'm watching the Qs. It's down about $4. Yeah.
And we saw it happen with Google earlier this week. We saw it happen with Netflix. So yeah, just fundamental economics are going to affect the stock market over and above whatever the Fed does with interest rates. Now, the Fed has said that, I think isn't the forecast for like, I don't know, 9 rate hikes this year or something?
They just kept upping it, and I just stopped paying attention. Yeah.
Yeah. And so, that would suggest that by the end of the year, the Fed funds rate should be over 2%. I think if they take it over 2%, we're going to, I don't know if it'll happen all at once, but the stock market will probably end up going below where it was at the bottom of the crash in March 2020.
Yeah, yeah. You and I are on board with that. You and I kind of talked about that earlier in
So
the year.
as it relates to the housing market, and again, as you and I have been chatting about, and as there's certain areas of the country that are extraordinarily hot because they're getting a lot of people moving out of other areas of the country. Like California, there's mass exodus from California.
Yeah, I left in 07 and knew it was in trouble. I can't believe people waited till 2020 to finally evacuate.
Yeah, and they're going to places like Phoenix and Vegas and
Sure.
Austin, Dallas, Fort Worth, Denver.
I've seen a lot of California plates here too.
Yeah, I know. I hate it.
Yeah.
Yeah, here, unfortunately, a lot of Midwestern and Northeasterners are going to Florida. A lot of Wall Street firms are locating their headquarters down in Florida. A lot of big hedge funds are doing that.
Do you think in the majority of places, or maybe a national level, it would slow housing, or do you think?
I think at the national level, I think housing's already slowing. I mean, we're seeing that in the numbers, and they keep blaming it on low inventory, but that's nonsense.
Yeah,
because you can see from that garage that guy paid over list for, whoever paid over list for it. You can see that people don't really care about the quality of what they're buying. There's inventory on the market, and there's new home inventory. We've seen existing and new home sales generally have been in a decline, the volume, since I want to say probably August of 2021.
Mm-hmm.
Now there's been some months where it spikes up for whatever reason. Like in January, we had a spike up. There's exogenous reasons for that. I think a lot of people tried to rush, who wanted to buy a home, just went out and bought one ahead of rate hikes.
Yeah.
But that were well telegraphed. And certainly, for sure, the relatively low inventory has had an impact on volume, but I think more so, I think the exorbitant price levels have had a big impact on volume. And I think I saw a stat the other day, and I don't want anyone quoting me on this, but it's in the ballpark. I think it was something like 75% of everyone who wants to buy a home that doesn't have one, the housing market's unaffordable.
Yeah, and I to be super honest, yeah, like I'm getting closer to that. And my wife and I, our income's much higher than average in our area, and I'm looking at this stuff going like I'm getting close to being priced out, especially if rates keep going up.
Right. Yeah. I just think that people who are buying houses now, if they don't care about the value of the house 2 years from now, and they just want somewhere that they can call home and they want to live, go for it. But if you like, most people I know, they care about the value of their house.
Yeah.
And if you're buying a house right now, I would say there's a 90% chance that 2 years from now, it's going to be worth a lot less.
Yeah, I'm in the same boat. And now let me play devil's advocate here, and I try to listen to the other side of the story. And in some
Greg,
of this, actually, yeah.
You have horns growing out of your head right now.
Yeah, I guess I do. I just lost my train of thought. I try to listen to the other side of the story, and some of the stuff kind of makes sense to me. It's like, look, people that bought with, literally probably the lowest rates you're ever going to see, those people, unless they default on their home, they're not probably ever going to move. So we will probably see demand destruction, in the sense that inflation, like you were saying, too much money printing has pushed these homes up to crazy levels. But you get all these people that probably can't move up because interest rates have gotten too high, and they're not going to probably do a lateral move. So they're probably going to be stuck and sitting in their homes for an exceptionally long time, which means it could keep inventory somewhat depressed. Like what's your take on that?
There's a couple variables involved here, and one is people. There's going to be a fair amount of people who default and get foreclosed on. So that you realize that since April 2020, there's basically been a foreclosure moratorium. I think it was lifted in January, maybe something like that. You can Google it and look it up.
There's still people in forbearance. I
Yeah,
think to the tune of a few million.
Yeah, in fact, I think I just read the other day they're extending for certain income demographics. They're extending the forbearance period.
Oh
well,
who
do you think pays for that? The taxpayers pay for that.
I didn't
Banks
know
aren't
that.
taking the hit on that. It's the taxpayers. But what's going to happen is you're going to have, especially with people over the last 3 or 4 years who stretched to buy a home, meaning, at most they put down 3%.
Yeah.
And they basically were like, I mean, I don't care what anyone says, these mortgage underwriters are still looking the other way on a lot of things. And you got people who, a lot of people are buying a house where like 60 to 70% of their after-tax income is going to debt service for the house and the cost of maintaining the house, right? Because the cost of maintaining a house is a lot more than just the debt service on it. The mortgage payment, which probably has real estate taxes built into it. It doesn't have the cost of insurance, homeowners insurance built into it, and all the other expenses. We're about ready to have to probably do a major overhaul to our automatic sprinkler system. I mean, that's probably looking at least $3,000 to $5,000 there. So it's like that. I just replaced the water heater about a year ago. That wasn't cheap.
Yeah, that's where
I put in a new furnace 2 years ago.
That's where I get lost on what's going on, because pre-COVID, the average American didn't have $500 saved up without having to access credit. So I don't know how anyone buying a house can do exactly what you just said. I mean, I don't think COVID for the average person, increased their savings a lot to be able to buy, HVAC equipment if it goes out on you. It's very interesting.
It did from the stimulus payments briefly, but you could see, and you get my short sellers newsletter.
Yeah.
I mean, you could see in the economic data when the stimulus payments had been spent. You get a bump in the economy when the stimmies went out that lasted for a handful of months, and then all of a sudden the economic data started heading south again, and we saw that happen last summer. A lot of the hard economic data, especially when you strip inflation out of the numbers, started heading south. So I mean, like I said, a lot of people, not all of them, but I would say a majority of people who bought homes in the last 3 or 4 years really stretched everything, every which way they could.
I know that for a fact, because I have a lot of my friends were doing that.
Yeah, so there you go. Now, what's going to happen when all of a sudden, because of price inflation, they have to make the choice between a mortgage payment and putting gas in the car and feeding their kids? Guess what? At some point, everyone's going to start doing that at once. I mean, especially with the housing market, when it starts going in one direction, it's like a runaway freight train without brakes.
Yeah.
But then all of a sudden, you run out of track and the brakes aren't working. So that's where you have it's a slowly then suddenly effect. And I think that's probably what we're going to see in the housing market. And I actually kind of feel like it may be starting now, like in my area, in the North Table Mountain area, in East Golden, West Arvada. Houses were going almost immediately when they went on the market. The house behind us went on, was never even listed. It just, all of a sudden, the previous owners were gone and new people were in there. It never went on the market. I showed you the listing of that house across the street. I mean, it's been sitting for, I mean, it's been coming, it was coming soon for about 2 weeks. And it officially started showing it last Saturday. And I mean, I wasn't watching it all day long, but whenever I was, would go out to run errands or whatever, get in the hot tub, I think I saw maybe 1 or 2 people go into the house to look at it, and it's still on the market. And then there's a few other homes around this area where they've been, the for sale signs they've been up for a month. And
Yes.
that 6 months ago, that wasn't happening.
So no, so I can 100% verify that. So I waited to what I believe to be peak insanity. Once I think we went over the top, and so I'm agreeing with you. I've noticed a large slowdown. It's funny because my wife and I are just now looking, and I'm not even sure if we're going to get some. I just wanted to go out and see what we can look at. And my realtor keeps saying, look, you guys, because our price point's like between 500-600. She keeps going like, look, you guys need to look at stuff in the low fours, which by the way, there's nothing in Colorado in the low fours. But she was like, you need to look in the low fours because everything is going 10 to 25% over. And I was like, you know what? I just don't believe that. Like, let's please just go look. So we've only looked at 10 homes so far. 4 of the homes that did actually still go under contract only had one bid. So 40% of the homes that I've looked at only had one bid. So the bidding wars for sure have slowed down.
Interesting.
Yeah. Right. And I'm looking at her going like, where's, that 10-25% is not happening. Now, there are some in like real nice areas here, like, closer to everything. They still might have like 8 to 10 bids, but they're not going for 25% over. They might be listed at say 550. And then, it gets 10 bids, 5 of them are under. And then, it sells for like 560, something like that.
And you're talking about a hot area in one of the hottest markets in the country.
Yes. Yeah. And it's for sure slowed down from just since I've been kind of getting more or watching it more closely. And I do, let me ask one more question here. And you and I, again, failed to try to keep this to 25 minutes. Well,
I knew that would happen.
We're at 35. One of the and one of the other, like, devil's advocate, I guess. I'm not even sure if it's devil's advocate because I just keep watching this. I think maybe I was going to say you, Anna. I'll just speak for myself. One of my issues is that I think I come at things from like a capitalistic thought process. I went to government schools here. All I watch happen as soon as like housing or something rolls over, they just change the rules. So what's to stop them from coming out with like a 40 or 50-year mortgage, which I know that they're already doing for people in forbearance. They're offering some of those people like, hey, if you can't pay, why don't we just get you into a 40-year? What's to stop them from just changing the rules to keep the nominal price of homes from collapsing?
I mean, it's a question of whether the market is willing to take those mortgages, and at what price will they take those mortgages? Like, how much is it? I mean, I don't know if the government's going to subsidize the mortgage payment or backstop the mortgage payment in order to keep it down to a minimum rate, unless the government provides a hard guarantee on a mortgage piece of paper like that. I don't see the market taking it. So, and then, I mean, as a taxpayer, if the government itself just directly offers people that type of mortgage, I'd be livid. To the extent that a mortgage like that doesn't conform to economic reality, to the fact that it's in some way subsidized and risk protected, that's just further contributes to the devaluation of the currency.
Oh yeah, totally, absolutely. I'm just saying, I think they could keep nominal prices of homes relatively stable by doing weird stuff like that. But I would hope at that point, maybe we can transition into gold and silver going
just
up.
Really,
yeah,
just
go
really
ahead,
quickly though, because the biggest factor in what's happened with the housing market is the amount of money that the Fed has put into the housing market. In March, at the beginning of March 2020, so the Fed, in 2008, it was quote unquote QE money printing. It was dividing between buying treasuries, and then, which was basically a backdoor way to finance the government deficit, and buying mortgages, because they wanted to hold down the mortgage rates so that they could shove more people into homes and keep the economy going. At the beginning of March 2020, the Fed was holding 1.3 trillion in mortgages on its balance sheet. As of last week, it was holding 2.7 trillion. So
that's disgusting.
In the last 2 years, the Fed more than doubled the amount of mortgages that it was already holding. So it basically dumped 1.4 trillion into the housing market. Now you say, oh, well, they were just buying mortgages. Well, the mortgages translate into housing activity. You know,
Right.
it's housing sales activity. So essentially it's indirectly dumping 1.4 trillion of printed money in directly into the housing market, directly or indirectly, whatever you want to say. It's getting transmitted into the housing market. And that's what caught, and that plus the zero interest rate policy is what caused the price of homes to explode. And that is 90% of the factor in the housing prices and the type of housing market that we're seeing today. It's not supply, it's not demand, it's not, oh well, this is a great economy. We know it's not a great economy. We know it's not different this time. That is exactly why we have the housing bubble that we have. And we had the housing bubble in the early 2000s for the same exact reason. After the dot-com bubble, Alan Greenspan put his foot down on the monetary accelerator, and a lot of that money went into the mortgage market. Remember when he famously said Americans should use their houses as ATMs? Well, they were taking out home equity loans and going and buying more houses or doing whatever with that money. And they basically created an over leveraged housing system, on a macro basis. Well, we're at the same juncture where we are back then. It wasn't the subprime idiot flippers from jail that wrecked the housing market. It was all the people who took out home equity loans and then defaulted on their home equity loan. And then all of a sudden the value of their house is not only below the value of the first and the second mortgage, it's below the value of the first mortgage.
No, I couldn't agree more. I think that's exactly where we're at. The other thing that I noticed, 07, 08, I was living in California. Everybody I knew went out and bought a huge pickup truck in 06, 07.
Yep.
Not to drive it to their construction site, but so that they could drive it to their local grocery store and commute and come back. And now I'm like seeing stuff where guys roll in their F-250s. The gas pumps shut off at like $99. They can't even fill up their own. Like they gotta put the credit card back in just to fill up their trucks. And if the refi market, which I think is dead, I really think it's going to die if they are able to keep rates a little bit higher. That ATM or people using their homes like ATMs also dies. So you're not going to have people buying trucks. You're not going to have people buying cars, and you're already seeing demand just absolutely fall through a floor in autos. So, and like the chip shortage is starting to end, it's come back online. I think you're going to see autos collapse too. So,
oh, you're seeing it already. Absolutely.
Yeah.
Absolutely.
Let's transition into gold and silver here. Otherwise we'll be here all day. Not that I mind, I could totally do this, or all day with you. But before I do that, looks like Apple reported, looks like they beat across the board, and their stock is now down 1.5%. And the Qs, which I shorted, looks like it's given back all of today's silly gains.
Well, yeah, Apple's down. A colleague of mine who we're in a chat room together. He's actually on the Apple conference call. He's been posting updates in there, so I haven't had a chance to look at his updates, but I am watching Apple after hours. The big story is Amazon. Amazon's now down $340 after hours.
That's amazing. Well, that's good for my QQQ short.
Right.
All right, let's move
I
in.
actually bought Apple puts before the close, and I added more Carvana puts before the close. So,
oh, nice, nice.
So Amazon is down from the close. It's down 11.8%.
Wow. Yeah. I think tech's in a lot of trouble. Let's transition into gold and silver. And I have one question from two guys in the group, but what's going on with gold and silver? I personally I'm constantly disappointed by it. It just feels like, I don't know, it feels like it's stuck in the mud. What's going on with gold and silver?
I mean, that's how gold's traded for the 21 years that I've been, I started doing a deep dive in the sector. And it's, what happens is people like get attracted to it for various reasons. A lot of people get attracted to it because when the sector starts to gain upside momentum, it becomes something sexy to invest in. So, but I mean, again, there's a lot to unpack there, but just simplistically and generically, you've got a two-tier gold market. You've got the paper derivative gold market, and that's the price that we observe every day.
Right.
That's the COMEX.
That's the live price.
The LBMA, the London Bullion Market Association, Bullion Market Association. You know, that's traditionally had been the global physical market, but it's just become so corrupted with fractional bullion system and the, you know, their derivatives are called forwards, and the clearing volume on a daily basis just dwarfs the clearing volume of the forwards on a daily basis, just dwarfs the amount of physical gold sitting in the vaults. So what gets observed on a day-to-day basis is what's going on in the paper gold market. You don't see what's going on, especially in the Eastern Hemisphere, where the very large physical importers and physical buyers are. So you know, the derivatives market was established so that they could manipulate it, and that's what they've been doing. So, I mean, and in terms of the latest price action,
GDX is down about 14.5% since
April 18th. So
yeah, and like straight down. Yeah.
However many trading days that is. Yeah. Well, it had been up 30% since the end of January, right?
Yeah.
I mean, that 30% in 2.5 months is a ginormous move for any stock market index. I mean, if the S&P went up 30% in 2.5 months, they'd be doing naked cartwheels on CNBC, you know, basking in the glory. Well, no one heard that the GDX ETF was up 30% in 2.5 months, but that's what it was. And it had gotten very frothy. It had gotten technically overbought, and it was due for some type of price pullback. And what happens is, you know, just like when it moves quickly higher, it often will start to move quickly lower. Well, it had some help from, you know, Federal Reserve officials who were rattling their
peak inflation.
Yeah, well, and also rattling their chains about getting more aggressive with interest rate hikes, and that's what started to hit the stock market. And the day before the stock market went, a week and a half ago, the mining stocks got hit. A big part of the sell-off is in correlation with the stock market, and that's what happens over short periods of time. When there's a big move lower in the stock market, it affects everything. I mean, hedge funds are big players in the mining stocks and in COMEX gold futures. And when this markets start heading south, hedge funds, they start to sell everything that's not nailed down in their office, because they want to be first out the door ahead of everyone else.
I think that's really important, what you're saying, especially people that are, maybe they've only been trading for, say, 5 years, and they haven't lived through 2008 or 2001. That happens very routinely for anybody listening that's totally sick of silver. Exactly what Dave's saying. Or maybe they have margin calls or something, and they have an asset there. They have to sell it to make themselves whole. And it often, like, I remember specifically in 2008, because I'd gotten really interested in silver in 2006. I couldn't understand, because I didn't have you in my life. I couldn't understand why silver was collapsing, and then it led the charge out and went nuts.
Gold has actually been in a stealth bull market since March of 2021. I mean, it hit a bottom from the August 2020 pullback in March of 2021, and then it bounced, and then it pulled back to that bottom area in, I think it was July. I was looking at the charts just a couple of days ago, say July of 2021, and then it started into a gradual uptrend. Gold usually, in a healthy sustainable bull move, gold will lead, and then the large cap mining stocks will follow. So Newmont hit an all-time high 2 weeks ago. Most people probably weren't even aware of that, because it's not something that gets reported in the mainstream media, because they're not supposed to bring attention to the sector. But Newmont hit an all-time high like 2 weeks ago.
Yeah, awesome.
And then so the largest cap stocks move because the big institutional investors decide they need to have exposure to them, and then the sort of the mid cap stocks start to move, and then silver will take off. Sometimes silver will take off at the same time as the mid caps, then the juniors take off. Well, the juniors haven't even really taken off yet. So
Yeah.
I really feel like this is nothing more than just an overbought corrective pullback that
Yep.
was exacerbated by by being correlated with the sell-off in the general stock market. But if you recall from 2008, and I think the stock market's going a lot lower from here. If you recall from 2008,
Do you think miners and metals will follow it down this time, or do you think they'll?
Well, that's a good question. I don't know, and I actually laid out my thoughts in the mining stock journal that went out today, but I don't know. No one knows.
Right.
I mean, if the stock market goes sideways for a while, I think the precious metals sector is going to move higher. If the stock market heads lower again, which was obviously going to happen tomorrow after the Amazon and Apple results, then I think, there could be more downside to the sector. But if you recall from 2008, I mean, the precious metals sector got just destroyed between March 2008 and the end of October 2008. And the stock market also went lower. But what happened was there was at a point, then the end of October, all of a sudden gold started heading north, and so did silver. And then a couple of days later, the larger mining stock indices started heading north, like the Amex Gold Bug Index, or as we call it, the Huey. And I think that's what we'll see this time. I think, and then the S&P and the Dow and the Nasdaq kept going south until late March of 2009. So they, the mining stocks and the precious metal sector diverged positively from the rest of the stock markets about 5 months before the general stock market bottom. And the only thing that saved the general stock market was all the money that the Fed started printing. I do think at some point, and I don't know if it happens now or if it happens at a lower level in the precious metals sector, but at some point there will be a flight to safety bid that flows into gold and silver and pushes them higher, and then the mining stocks will follow. And again, I have no idea on the timing of that. I mean, it could happen tomorrow. It could happen 6 months from now. I don't know.
No, that's I appreciate the honesty. That's good feedback. I've got one question specifically about a miner, and then I'm going to give you the last word here. So Robert and Paul in our group, Robert was the one that asked it originally. Hey, ask Dave if he still believes in the fundamental reasons to own Fortuna Silver, because apparently I think he was part of your mining stock journal, and he found it because of you. So what are your thoughts on Fortuna Silver?
I mean, Fortuna is one of my number one plays. I think it's an incredible value play. I think that a large segment of the market that follows the mining stocks, first of all, I think it got knocked because of its acquisition of Rox Gold, and everyone's like freaking out because we owned it because it's a silver company. Well, it really wasn't a pure silver company before it acquired Rox Gold, and actually the Rox Gold acquisition. Every time I look even deeper into it, the more I'm convinced it was one of the most brilliant acquisitions I've ever seen, because West Africa, which is where the Rox Gold assets are, is probably one of the most undervalued gold mining areas in the world. And as a region, it's the second largest gold producing area in the world. The grade of the resource, the gold resource there, is just astonishing. There's parts of the mine or the project that they acquired in the acquisition, the Segela project, the mine is being built now, and they've been doing some drilling, some resource expansion on the Segela property, and I mean, there's just astounding grades for open pit style mineralization that they're finding. And in summary, yes, I think the fundamentals for owning Fortuna are as strong as they've ever been. They're as strong as they were when I first presented the idea in the mining stock journal. I mean, don't take it from me. The company is putting its money where its mouth is, because it announced a stock buyback program for up to 5% of the outstanding shares. and it specifically said that it likes to buy its shares back when it believes that the market is undervaluing the fundamental value of the company. And I agree with that wholeheartedly. And I'll contrast that with these tech stocks that do their buybacks. They buy back the shares so that they can push the price higher, so that insiders who get most of their compensation in shares can dump their shares while the company's buying back the stock. It's one of the greatest legal Ponzi schemes in the history of the world. Well, that's not what Fortuna does. And in fact, one of the I think it was the VP of mine operations for the Latin America division, like within the last 6 or 8 weeks, just bought a bunch of shares in the open market. And I know that Jorge Ganoza would be buying shares, but they keep getting into a blackout period with various things going on at the company where he has inside information that's not been made public yet, and it restricts him from buying shares.
Anyone has listened to us talk before. That's literally the reason. I love Dave. I pay for all of his subscription stuff. Dave does incredibly deep dives, or deeper dives, that I'm willing to do myself into a lot of different companies. I spend my time doing a lot of technical stuff. So I always love having you on. I love talking to you because you bring information like that to the table. I then take it and I go and look at charts. So for me, that was a fantastic response. Is there anything else you wanted to say?
Well, first, I just want to say,
or go ahead.
I just want to say I appreciate that, because your technical prowess is incredible. I mean, I just recall specifically, when we were talking about buying puts on Pfizer, and I was talking about it from a fundamental standpoint and the eventual lawsuits that are going to envelop it.
Yep.
And you were looking at it and you're like, nope, I'm waiting for it to hit 53. And remember that?
Yeah,
and
totally.
I think it hit maybe 53, may have overshot it by a little bit, and then headed south.
I don't know how long I've been subscribed to you, for years. And I mean, I just love how your brain operates. It's not really how mine works. So I think, I mean, really just be able to get a piece of your brain and how it works with the incredibly small fee that you charge for the Short Sellers Journal and Mining Stock Journal. I think the value is incredible there, and it helps me make money. And I appreciate you to the absolute max, and I can't give you any higher compliment than that. I just love having you on. I love talking to you. I love reading your stuff. And I thank you for you being you and willing to even come out here and share this information. You don't have to do this, and I appreciate it. And I think people listening to this appreciate it as well.
Well, thanks. I appreciate that. I really do. I also want to say you nailed the top in the nail ETF.
Oh yeah. No, you know what was funny? I threw that out to you and you were like, oh yeah, I forgot about that one. And then you were putting it in your Short Sellers Journal. I think I said that was a short at like 120 and it's like at 40 or something like that.
It's below 40. In fact, I bought more puts on it yesterday or 2 days ago.
Awesome.
I think it's going to go below 10.
That's sweet. That's sweet. All right. Is there anything else you wanted to add? Otherwise, we can wrap it up. We did a horrendous job of staying below 25 minutes, but we are about to stay below an hour. So I'll take that for a win. You got about a minute.
What I would just say is just be leery of all the propaganda that is flying around out there. And I mean, the people running this country and the propaganda machinery has really turned everything inside out. And it's hard to tell what's real and what's not. So, just assume that, when you hear something in the mainstream media, assume it's not true and make sure you investigate it yourself.
Yeah, that's great advice. I live by that. Just because somebody is trying to sell you something or tells you something, you don't have to instantly absorb it. And honestly, I don't think that you should, unless you really, really trust those people. But I do what you just said. I always try to double check, and I think that's a good way to live life. So why don't we end it on that note? And once again, Dave, thanks for coming on here. I super appreciate it. So have a great.
Thanks for having me. I always enjoy our conversation.
Yeah, so do I. And you're welcome back anytime you want to come on.